Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tonnage updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at 10 a.m. and 4 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, take a look at the world around you. Geopolitical conflicts are escalating. Supply chains are choking. The global financial system is suffocating under 40 trillion of systematic debt. By all traditional academic metrics, the global economy should be in a severe depression. And yet, the stock market refuses to crash. Every time we see a severe sell-off, it's violently erased by an aggressive V-shaped recovery. Have you ever asked yourself why? Why has the market completely detached from fundamental reality? The truth is, we are no longer operating in a free market. We are operating inside a highly engineered anti-crash architecture. Let that sink in, ladies and gentlemen. This is very important. But beneath this artificial floor lies a terrifying macroeconomic reality. The United States government is trapped. It fundamentally cannot afford a recession without triggering a sovereign debt death spiral. In today's deep dive, we're going to expose the four hidden forces artificially propping up your portfolio. We'll break down the terrifying math behind the 39 trillion US debt crisis, but most importantly, I am going to show you why the legacy financial system is physically incapable of surviving this paradigm, and why a specific digital asset, XRP, the anointed one, is quietly positioning itself as the absolute forefront of this macroeconomic reset. This is the institutional playbook they don't want retail to see. So grab a pen, let's dive in, and thank you to everyone that takes the time to like, subscribe, share. That really does help out the channel very much. To understand where we are going, you have to understand why the 2008 style crash hasn't happened yet. There are four distinct mechanical pillars holding up global equities right now. Pillar one, the Fed put. Since the great financial crash and massive accelerated in 2020, the market has been trained to believe the Federal Reserve will always save them. Why? Because U.S. household wealth sits at a roughly 184 trillion, and a staggering 47% of that, excluding primary homes, is locked in stocks. If the stock market crashes, that wealth evaporates, consumer spending dies, and the economy collapses. To prevent this, the Fed is constantly interjecting stealth liquidity. Even today, they are quietly interjecting roughly 40 billion a month into the system under the guise of reserve management. Let that sink in. But the kill switch to this Fed put is inflation. If inflation stays high due to oil prices and supply chains, the Fed can't print money without triggering 1970-style stagflation. Pillar two, the passive money machine. In 2010, passive investments like index funds and ETFs made up just over 19% of the market. Today, it's over 60%. This is a bathtub with a faucet that never turns off. Every 2 weeks, 401ks, contributions blindly buy the market, regardless of the valuation. Because of this blind buying, the market is hyper-concentrated. Just 7 mega-cap tech stocks now make up 40% of the S&P 500. But this has a fatal flaw: demographics and employment. Let that sink in. As baby boomers retire, they transition from net buyers to net sellers. And if unemployment spikes, that passive faucet turns off and the drain opens. Pillar three, algorithmic trading. A massive share of daily volume is run by commodity trading advisors, CTAs, or as we call them, the lemmings, computers that trade purely on momentum. When markets drop, they sell mechanically. But here's the secret: they only sell what they own. Once their inventory is dumped, the selling is exhausted. The algorithm instantly flips, violently buying back into the market, engineering those V-shaped recoveries that crush short sellers. Pillar four, institutional hedging and retail. Finally, hedge funds make billions selling option premiums. When the market tanks, these dealers are mathematically forced to buy the underlying stocks to hedge their books, acting as a massive shock absorber. Add this to the retail trader who now makes up 20% to 25% of daily volume, consistently buying the dip with diamond hands. Ladies and gentlemen, these four pillars have made the market invincible, but they are hiding a rot in the foundation of the sovereign bond market. Write that down. Here is the terrifying macroeconomic reality. The United States simply cannot afford a recession. Write this down. Not politically, but mathematically. The federal government relies entirely on tax revenue. During a recession, income taxes, corporate taxes, and capital gain taxes all plummet simultaneously. Let's look at the data. In the mild recession of 2003, the federal revenue dropped 10%. During the 2009 financial crisis, it collapsed by 18%. Today, the government collects roughly $5 trillion in taxes, but it spends over $7 trillion. The math's on the wall, the writing there is. That is a structural $2 trillion deficit every single year during an economic expansion. This is so massive, and you're not going to hear this on legacy news media, ladies and gentlemen. This reckless spending has driven our national debt to $39 trillion. This is crazy. Our debt to GDP ratio sits at a terrifying 122%. If we hit a recession tomorrow and tax revenue collapses, automatic stabilizers spending will surge, pushing the debt to GDP to 140 to 160%. That is the mathematical breaking point for a sovereign currency, ladies and gentlemen. This is it. But here's the real danger. It's the bond market. To fund this $39 trillion debt, the government issues treasuries. If bond vigilantes lose confidence in the U.S. fiscal trajectory, they demand higher yields. If bond yields structurally shift into the 5 to 7% range, it will suck all the capital out of the stock market. Worse, the U.S. government is currently paying $1 trillion a year just in interest rate expense on the debt. If rates stay high, the interest payment will consume the entire federal budget. Nobody talks about this, ladies and gentlemen. Again, this is not financial advice, just my personal opinion, and anyone attends any capacity. This is what we tell family offices and people that retain us any capacity. The hard truth, the mathematics behind things that no one really wants to talk about. You can't be an ostrich and stick your head in the ground. This leaves the government with only two choices, ladies and gentlemen. Choice one, allow deflationary depression. Prices fall, but the $39 trillion debt remains the same, making it mathematically impossible to pay off. The system defaults. Choice two, print money aggressively, debase the currency to inflate away the real value of the debt. Historically, politicians will always choose choice two. They will execute massive quantitative easing. They will accept punishing long-term inflation to save the system today. The U.S. dollar will lose its purchasing power, and its status as the global reserve currency will be deeply fractured. Which brings us to the ultimate question. When the fiat system breaks, what replaces the plumbing? What do you think, ladies and gentlemen? I want to hear you in the comments. This is exactly where we pivot from macroeconomic theory to the future of financial infrastructure. As the U.S. dollar is inflated away to manage this $39 trillion debt burden, global central banks, massive financial institutions, and sovereign nations are realizing they can no longer rely purely on dollar-denominated SWIFT-based legacy system. Let this sink in. Let this sink in. The old system is now slow, expensive, and trapped in an era that doesn't exist anymore, ladies and gentlemen. Currently, to move money across borders, banks have to use Nostro and Vostro accounts. This means they literally have trillions of dollars of capital sitting dormant in pre-funded accounts around the world to just facilitate cross-border trade. Remember what we just talked about, ladies and gentlemen. Capital is no longer free. With government bond yields at 5% to 7%, banks cannot afford to leave trillions of dollars sitting in dead Nostro-Vostro accounts. The opportunity cost is astronomical. They need a system that offers instant, on-demand liquidity, ODL, without pre-funding. Enter XRP, the anointed one, and the XRP ledger. XRP wasn't built to be a meme coin, ladies and gentlemen. It wasn't built for retail speculation. XRP was explicitly engineered from day one to be institutional-grade macroeconomic plumbing. It is designed to act as a neutral bridge asset between differing fiat currencies and inevitably between central bank digital currencies, CBDCs. Think about the $40 trillion in systematic global debt, The financial friction required to service more and move and settle that debt in the legacy system costs the global economy hundreds of billions of dollars a year. XRP eliminates that friction entirely. When a financial institution uses XRP, the anointed one, for on-demand liquidity, they don't need to hold the destination currency. They convert fiat A into XRP, move it across the world in 3 seconds, and convert it instantly into fiat B. It frees up trillions in dormant capital the banks desperately need to deploy into high-yielding assets to survive this macroeconomic environment. Furthermore, as we look at the geopolitical landscape with the weaponization of the US dollar and the rise of the BRIC nations, there is a massive global push towards de-dollarization. Nations want to trade without touching the US banking system, but they still need a neutral, trustless settlement layer to swap their fragmented local currencies. XRP is perfectly positioned as that neutral bridge. As inflation ravages fiat currencies, XRP operates with a fixed maximum supply of 100 billion tokens. With a small fraction burned as gas in every transaction, it is inherently deflationary by design. A stark contrast to the endless money printing we are about to see from the central banks when Operation Printed to Win It begins, ladies and gentlemen. While the Mag 7 tech stocks are currently benefiting from the passive money machine, the actual structural foundation of global finance is actively migrating towards blockchain technology. And Ripple, the company leveraging XRP, the anointed one, has spent the last decade building relationships with regulatory bodies, central banks, and financial institutions worldwide to ensure XRP is the complaint regulatory cleared asset to do this job. So how do you manage your wealth as an ultra-high net worth investor navigating this scenario? This is not financial advice, just my professional opinion. Anyone understands any capacity. I have built 2 frameworks based on these institutional money flows. Scenario A. The system holds for now. If the central banks continue to successfully print money and the algorithmic pillars hold, you stay invested in equities, but you must aggressively monitor bond yields and inflation data daily. Scenario B. The system breaks. When the demographic shifts, accelerates, or bond vigilantes push rates to 7%, the system will fracture. We're already positioning capital ahead of this. You must diversify into hard assets. Look at the data. Recently, while broad markets returned to meager 2%, institutional money flows pushed oil and gas service up 48% to 80%. Coal mining jumped 40%. Pipeline construction yielded 20 times the market average. Why? Because the energy is the foundation of the physical economy. It's also the foundation for the AI kilowatt wars that we go over all the time. And just as you hold physical gold and energy infrastructure to protect against fiat debasement in the physical world, you must hold high utility assets like XRP, the anointed one, to protect against fiat debasement in the digital world. XRP, the anointed one, is the digital oil of the new financial system. Ladies and gentlemen, the greatest danger to your wealth right now is complacency. Do not assume the upward trajectory of the last 15 years will continue smoothly. The 40 trillion debt is a mathematical reality. The 1 trillion in annual interest payment is a mathematical reality. None of this is financial advice, just my professional opinion. Anyone who has any capacity. The fiat system will be inflated. The purchasing power of your cash will drop. And the financial architecture of the world will transition to highly efficient blockchain-based settlement layers like XRP, the anointed one. Follow the money flows, not the news. Understand the mechanics of the market. Protect your capital with hard assets. Position yourself in the infrastructure of the future before the masses realize the transition has already happened. Ladies and gentlemen, if you want to survive the coming macroeconomic shift, you need the right data. Make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss my next institutional briefing. Let me know in the comments down below. How are you positioning your portfolio to the 40 trillion debt reset? Until next time, protect your capital, stay ahead of the curve, ladies and gentlemen, and don't get caught up like sushi. Keep the Gucci conviction. Good morning, ladies and gentlemen. We got a lot of things to talk about. It's fantastic to be back here with everyone in the morning. Big news overnight is oil. I want to welcome all the new members of our Patreon, all the new members of our membership channel. As always, ladies and gentlemen, remember, one good tip from the pits can pay for your entire year subscription. Come and join over 525 active traders and investors inside the Crypto Republic Desk monthly. Doesn't matter if you're new or veteran. Ladies and gentlemen, gold broke below the support level, 4665. It broke. Again, now look out below at 4570 breaks. Oil's on the move. It's on a tear. These macro themes and financial players all have a pulse in everything. Again, with silver, the lemmings and CTAs who are going to get cut up like sushi from groupthink and have no creativity, they're going to be selling into 73.70. If that range breaks lower, the wind of geopolitical twigs below it send it lower, silver's play is structurally strong. Again, it's still structurally strong. You got May deliveries coming. COMEX doesn't really have much. But again, you see when the lemmings start to sell. But the real news, and this is so important, and if you want to write this down, write this down. If oil stays above 94.55 and it clearly clears above 106, we are targeting 115. That's in the kill zone. But on the downside, if it violates 94, it's going to go sub 90. And this is the what if forest. Ladies and gentlemen, when we talk about the path of least resistance, that is what Wall Street does. You're not talking about brainiacs. You're not talking about brain surgeons. You're not talking about some AI that can do something better than good old-fashioned floor trading. You're not, because they just follow everybody else. And if you follow everybody else, you follow them all the way to the food lines. Again. And you get cut up like sushi. But I have been harping for months that money will find what it has to. Funds have got to make their weekly numbers, their monthly numbers, their quarterly numbers. They got to, okay? Oil is going to move higher. Goldman Sachs and Bank of America came out talking in a report early this week that gold is going to go lower and oil is going to go higher. Why? They didn't come out and say gold is going lower. What they came out and said was maybe to their customers, you should have exposure to other assets that they have. That is reading beneath the surface that oil was moving higher. And as they begin to push the oil projections higher, other assets will go lower because it is a true risk off. So right now, you see at the time of recording, you see XRP at 137. You see ICP 239. You see Bitcoin at 76. Again, you see gold at 45.76, silver at 72. So it's below certain levels that we were talking about yesterday. But again, this is what funds do. They find the path of least resistance. They stock up, and this is what's happening. Does anybody really think that when we talk about Operation Print It to Win It, what's really going to happen? We just went over this. The U.S. has a massive debt that has to be refinanced. Oil is moving higher. Iran has X amount of days left with storage capacity. It's a recipe for a brand new rewiring of financial trading, but as financial mercenaries, having the Gucci clarity, Gucci conviction means to pick apart what is going to get us alpha each day. Again, the whole thing right now, I told you about the Widowmaker that we follow in Japan when Asian tradings. It's oil. We watch what's happening in the Shanghai silver markets and COMEX. But right now it's about oil, which we have been preaching. And I've been saying this to every family office that has been retaining us and every hedge fund that oil is moving higher. We're in a financial war. It goes back to this, the east and the west side of the tranche. This is what happens. As the remora, we will not get cut up like sushi. We will follow the path of least resistance while accumulating the best assets for when Operation Print It to Win It begins. But ladies and gentlemen, understand, just 1 week ago, Bank of America stated oil futures were way too cheap. Goldman and Deutsche Bank seemingly concurred and put out their own pricing upgrades for oil. Markets are facing a sustained supply shock driven by Hermes disruptions. Let that sink in. Enforcement actions and delayed recovery timelines, record inventory draws, and tightening conditions. Despite soft demand, while limited supply responses keeps the market undersupplied, price risks are skewed higher, with forecasts rising and upside scenarios pointing to significantly elevated oil prices. Ladies and gentlemen, the global oil market is shifting from disruption to a cumulative supply shock. What began as a localized bottleneck around the Strait of Hormuz has evolved into a layered constraint system involving reduced flows, active enforcement, and delayed recovery timelines. The result is going to be a tightening supply profile that is overwhelmingly baseline and forcing a repricing of risk. So what analysts on the street and from Deutsche Bank and Goldman Sachs, they converging on 3 points. One, disruption is intensifying, normalization is being priced out and pushed out, and price outcomes are skewing higher. Ladies and gentlemen, the system's absorbing a shock that's both larger and more persistent than initially assumed, again. So when you look at supply disruptions and that becomes structural, that becomes the new norm, this is what we're talking about always. So when you look at the Strait, it remains a central point of pressure. Its reduced tanker transit volumes and U.S. vessel seizures are compressing export beyond what surface flows data suggests. They're moving a very old oil tanker to basically take on supply. You also have public officials in Iran coming out on TV and telling people to conserve energy. You don't need to have 10 lights on in your house, have 2. See what the data is saying. Don't pay attention to the noise. That's how you're going to get cut up like sushi. The data updates points to new developments and intensified supply disruptions recently, with fewer ships going through the strait and U.S. vessel seizures from the United States totaling 8 million barrels of crude daily. This introduces a second layer of constraint. The flows are not declining. Not only, they're being selectively restricted, distorting traditional export proxies. So Goldman Sachs, they quantify the scale of disruption. They're estimating around 14.5 million barrels of Persian Gulf crude production losses, and they're driving global inventories to draw a record 11 to 12 million in pace in April. That's massive, ladies and gentlemen. Let that sink in. Both institutions now are pushing normalization to late June. If you look at where futures are pricing oil, it tells a different story. It's extending the duration of the shock. The reality is dawning again. So the earliest data straight reopening looks likely to slip from May to June. But longer timelines increase operational risks. Reservoir pressures, declines, and restart inefficiencies raise the probability that part of the lost supply becomes persistent. So this is not coming back online, ladies and gentlemen. The transmission from supply shock to prices, it's occurring throughout inventories. It's happening in the numbers. Again, we all see this, but they're not going to tell you this on the mainstream media because that destroys their narrative. The drawdowns are accelerating to record territory. The scale shift inventories from a buffer to a signal. So as stocks decline, again, price behavior becomes increasingly nonlinear. The global visible total oil inventories are likely to reach the lowest level on record. Again, let that sink in. So even in the most benign scenarios at critical thresholds, price formation moves away from marginal cost towards scarcity pricing. The system begins to embed uncertainty around replenishment and supply reliability. So if you look at demand weakness is insufficient, demand is adjusting, but not enough to offset the shock. Let this sink in. Ladies and gentlemen, you can see what's happening. Once oil pushes higher, all the dominoes fall. And all the things that all these gurus tell you gets wiped out because they're all getting cut up like sushi because they're not telling you the news anymore. If you go back to the beginning of the video, they're telling you what they need to tell you, what's being forced to tell you this. Most people assume that global oil demand falls on a year-over-year basis, given the jump in refined products, again. But higher production prices and shortages are supporting consumption, particularly in price-sensitive regions. However, the scale of demand destruction remains well below the margin and magnitude of supply losses. Ladies and gentlemen, this is so crazy because all of that is being transitioned now to the Gulf of America, Operation Energy America, Operation Printed to Win It. Again, this is designed to change the financial world, and it's happening. We saw it happen in silver. It's happening in energy right now. But weakness is more visible in China through declining refinery runs. China is selling their oil to other countries in Asia right now because their factories are not working at capacity. Again, so while U.S. demand remains closer to seasonal norms, this fragmentation limits the ability of demand to rebalance the system efficiently. Again, so when you look at supply growth outside of the Gulf, that's constrained. Again, so according to the banks, they're forecasting 2026 global supply is going to be 1 million barrels higher than before the Hormuz shock. So think about that. The Gulf is rocking and rolling with business. So increases from the United States and Russia are modest. They're relative to multi-million barrel disruptions. Ladies and gentlemen, we're going all of this because this is going to set the tone for all the financial markets moving forward for the rest of the summer. Again, this is what's happening and how not to get caught up like sushi. So structural limits are in shale, geopolitical risk, and capital discipline restrict the entire response. Look at what's happening right now. The lemmings are having a field day, ladies and gentlemen. But stabilization is deferred. And in our opinion, the Gulf producers are expected to increase output above pre-war levels once flows normalize. But until then, the system operates with limited redundancy. So if you look at this, policy is now a direct market variable. Enforcement actions are actively constraining supply. Ladies and gentlemen, the United States would continue to pursue Iranian ships and vessels of the so-called dark fleet in the days ahead. That's what we're going to see. This adds a layer where supply is selectively targeting increasing. So according to Goldman Sachs, they introduced an additional policy risk. According to them, they don't rule out the U.S. oil export restrictions, which may reduce U.S. and global crude products and production and widen the international versus U.S. price gap. So according to Goldman Sachs, policy can therefore act as both a constraint and amplifier, shifting the market beyond a purely physical framework. So price forecasts are moving higher according to both banks, with skewed to the upside. They're upgrading their 2026 Brent WTI forecast to 90 to 83 with net upside risk to price oils. Shock. So this reinforces their asymmetry. Brent 2026 Q4 would average just over $100 and nearly 120 in a severe adverse scenario. You got to write that down. That's so massive. That's where we're going. Downside requires rapid normalization across flows, and capacity upside requires only persistent current constraints. As inventories decline and spare capacities release, pricing shifts towards a security paradigm. Ladies and gentlemen, the whole system is under duress. The entire system is changing. And why I say the entire system is changing. Demand is weakening, but it's not inefficiently enough yet. Internal supply responses remain limited. The combination of lesser exports and reopening means the probability oil prices are above forecast. It's also increasing. Ladies and gentlemen, they're not going to come out and give you price targets that we're giving you. And again, ladies and gentlemen, if you want to understand all of this, come and join us at the Crypto Republic Desk monthly. One tip from the pits can pay for your entire year subscription. Join over 525 active traders and investors who are taking their destiny into their own hand, and they're not going to just be pushed around by the narratives anymore and watch their life savings get pushed lower and their trading accounts get up like sushi. Join everyone who's decided to take it into their own hands and become a financial mercenary. Because guess what? If you made it to the end of this video, you understand what's going to happen and why you don't get cut up like sushi. Why people retain us in any capacity? Because we tell you the truth. We tell people what they need to hear, not what they want to hear. I always say you make a living by what you make, but a life by what you give to other people. To understand this right now, this is going to give traders, funds, the capacity to make a lot of alpha in short-term trading and positioning, and then to position into the best cryptos, XRP, the anointed one, ICP, the anointed one, HBAR, the anointed one, into the future. Because now, see, banks don't come out and say, we're going to the moon. They don't do that. No. They want their customers and their clientele to slowly get exposed to other assets they can offer them, keeping them in-house. That's what banks do, right? Yes, they went over copper. Copper is massive right now. The entire commodity war is on, ladies and gentlemen. I had gone and given you the BRICS and the west side of the tranche. It's on and live. It matters what you do right now is going to set the tone before Operation Print It to Win It begins. But as always, ladies and gentlemen, I love you. I'm going to see you on the front lines. This content is for information entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Always. Remember, the game's changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You got two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they never let it happen again. Or you could be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right until the moment they're not. And this is one of those moments. Do not blink, because the world is distracted with noise, while XRP continues developing behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Don't get cut up like sushi. Your move now will be remembered. It's not the end of the story. It's just the beginning. This opened your eyes. Smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all. I'll see you at 4 p.m. today.